Welcome to this deep dive. Today we're exploring a really fascinating and honestly kind of an eye-opening video transcript from the creator Wariku.
Oh, yeah, the one recorded in late 2025.
Exactly. It details this massive, fast-moving phenomenon that he identifies as financial nihilism and, well, basically the modern debt trap.
It's such a critical subject, because it fundamentally challenges everything that previous generations understood about earning, saving, and spending.
Right.
I mean, we were looking at a complete rewiring of consumer behavior here.
And that actually brings us to our mission for today's deep dive, which is to dissect how the entirely frictionless nature of modern technology has just rewired how a whole generation, specifically Gen Z, right, interacts with money.
Yeah.
We're going to uncover the hidden long-term costs of those short-term conveniences sitting right there on your phone. So, okay, let's unpack this.
Let's do it.
Because to really understand the scale of this, you kind of have to put yourself in the shoes of a young professional today. So picture this. It's the second day of the month. You're lying in bed, maybe around 9:00 p.m., mindlessly scrolling through your feed when a beautiful notification pops up.
Best feeling in the world.
Right. Your salary, let's say it's $62,000, has just hit your bank account.
And, I mean, it's a universally validating moment that notification basically signals independence. You feel like a successful adult who is, finally building a life.
Absolutely. You fall asleep with a smile on your face, dreaming about how you're going to use that cash.
Yeah.
But then you wake up the next morning, you check your phone, and there is just a wall of automated SMS notifications.
Oh, no. The auto deducts.
Yep. Your rent, $22,000 automatically deducted. A credit card bill, $14,000 gone. That laptop you bought on EMI, $4,800 cleared.
It adds up so fast.
Yeah. It does. And then come the ones you barely even remember making, right? Lazy Pay took $3,200. Amazon Pay Later claimed $6,100. That personal loan you took out for your sister's wedding, another $9,500 vanished. Oh, and some random food delivery app via Simple just deducted $800.
So the transition from abundance to absolute scarcity happens overnight, literally while you're sleeping.
Literally. You were the proud owner of $62,000 when you went to bed. You wake up and your balance is $400.
Wow.
You haven't even bought a single meal yet, the month hasn't even truly started, and your money is entirely gone. And my first thought when reading through this scenario is just sheer confusion about the mechanics of it all.
How they actually got there.
Yeah. I mean, in the past, getting a loan meant taking half a day off work, sitting in a bank branch, drowning in vehicle paperwork, and just hoping a manager approved you.
Right. And if they did, you distribute sweets to your family to celebrate.
Exactly. So how does someone today accidentally rack up 5 different loans without signing a single physical piece of paper?
Well, what's fascinating here is the complete removal of psychological friction. It's no longer about intimidating paperwork. It's entirely about seamless clicks.
Seamless clicks.
Right. The digital infrastructure has been intentionally designed to make borrowing money feel identical to spending money you already have. And to understand this trap, we really have to look at the 3 main categories of modern consumer debt that are driving this trend.
Okay, let's break those down. The first category is the traditional credit card, which, I've always viewed as a double-edged sword.
Completely.
Like, used correctly, it's a great financial tool. You get 30 days of interest-free liquidity, you build a solid credit history for a future mortgage, and you rack up reward points. Smart money always uses credit.
Sure, that is the ideal scenario, assuming the user pays the balance in full every single month.
Right.
But the UI of credit card statements often highlights the minimum amount due in bold. It's practically encouraging you to only pay a fraction of your bill.
And that's where they get you.
Exactly. When you do that, you aren't paying standard bank loan rates of 10 or 15%. You are hit with staggering interest rates of 36 to 48% on the remaining balance.
Wow. Which brings us to the second category. And this is the one that really seems to be fueling this new crisis. Buy now, pay later, or BNPL. Apps like Simple, Lazy Pay, Amazon Pay Later.
Modern layaway.
Yeah, I think of BNPL apps like invisible leaks in a boat. If you take out a massive bank loan to buy a car, you know you have debt. There is a giant piece of metal sitting in your driveway reminding you of your obligation.
It's tangible.
But with BNPL, you are financing a 499 biryani order. You're financing a 1,200 petrol charge.
And because these options are embedded directly into the checkout process of almost every app, tapping that button feels exactly like a standard UPI payment.
Exactly.
The brain doesn't register the action as taking on debt. It doesn't hit you until the end of the month when your boat starts sinking under the weight of, like, 50 tiny forgotten microloans.
But wait, I have to push back a little here. Isn't BNPL actually incredibly helpful for people living paycheck to paycheck who genuinely need to spread out the cost of essential goods, like groceries or emergency medicine? Why is the mechanism inherently bad just because it's easy?
Well, it isn't inherently evil,
Yeah.
but the danger lies in the indiscriminate nature of the technology.
Dick?
The interface doesn't differentiate between emergency medicine and an impulsive midnight sneaker purchase.
Oh, okay.
It removes the natural pause, that moment of hesitation where you look at your bank balance and ask, can I afford this today? By delaying the pain of payment, it artificially inflates your perceived purchasing power.
And that artificial inflation leads right into the third category, which is fintech personal loans.
Right.
These are those one-click instant loans from apps like CreditBee or Navi, no banker, no lengthy background check. You want $10,000, tap a button, and the money is in your account instantly.
And the data on these platforms is deeply concerning. The average loan size is around $9,700, with 91% of their portfolios consisting of loans under $50,000. These are just micro-injections of cash, often carrying interest rates anywhere from 18% to well over 36%. Furthermore, there is a whole dark underbelly of unauthorized predatory loan apps.
Oh, I've heard about these.
Yeah, they bypass standard credit checks entirely by demanding access to your phone's contact list and photo gallery.
Which is terrifying because if you miss a payment with those predatory apps, they don't just charge a late fee. They resort to digital extortion.
Exactly.
They will call your relatives, morph your personal photos, and just threaten to ruin your reputation over a few thousand rupees. It is genuinely terrifying.
It really is.
And because the friction of borrowing has been virtually eliminated across all three of these categories, the macro scale of this behavior is just exploding.
Exploding is the right word. The numbers from 2025 paint a stark picture. The outstanding amount for the other personal loans category in Indian banks reached 15 lakh crore INR.
Wait, 15 lakh crore?
Yes. And to put the velocity of this growth into perspective, a decade ago, there were roughly 21 million credit cards in circulation. Today, there are 115 million.
That is insane.
In September 2025 alone, a staggering 2.25 lakh crore INR was spent on credit cards in just 30 days.
Okay, so who is actually holding all this debt? Because it's not people in their 50s financing their children's college education.
No, it's not.
41% of all this debt is held by Gen Z individuals born between 1997 and 2012. These are young professionals in their first or second jobs and, sometimes even college students.
And even more alarming is the stacking effect. 60% of personal loan borrowers already have 3 other active loans.
You're kidding.
No, they're using new debt to service old debt.
Okay, let's talk about the math of servicing that debt, because I want to go back to that minimum amount due trap on credit cards. Here's where it gets really interesting. Let's say you have a 1 lakh credit card bill. Things are tight, so you decide to just pay the 5,000 minimum amount due every month. You see the money leaving your account, so psychologically you feel like you're actively solving the problem.
You feel responsible because you haven't technically defaulted.
Right. But because of that 36 to 48% compound interest rate, if you only pay that minimum, it will take you 21 years to pay off that initial Euro lakh.
21 years.
21 years. And in just the first 12 months, despite making a payment every single month, your outstanding balance will actually grow from 1 lakh to somewhere between 1.36 lakh and 1.8 lakh. You are bleeding cash, and the hole is only getting deeper.
It's a very vivid illustration of how compounding interest can work against you. It accelerates your wealth destruction faster than your income can repair it.
Which brings up a massive question. If young professionals are taking on this unprecedented historic mountain of debt, what on earth are they actually buying?
That is the million-dollar question.
Because historically, heavy debt was associated with acquiring appreciating assets like real estate or investing in future earning potential, like getting a degree.
And that is the core of the financial nihilism argument we are unpacking today. They aren't buying assets. They are financing aesthetics.
They are paying for illusions. Let's look at the specific cultural trends driving this. First up, weddings.
Oh, yes.
The average Indian wedding now costs 15 lakh. That is 5 times the country's GDP per capita. People are taking out specialized wedding loans at exorbitant interest rates just to throw a 3-day party for 400 guests.
We really have to ask why a 15 lakh expense feels rational to someone earning a 62,000 monthly salary.
Yeah.
And it comes down to the environment they exist in.
Right.
The UI of lending apps is dangerously synergistic with the UI of social media platforms like Instagram. The algorithms constantly curate a baseline of luxury destination weddings, designer clothes, international travel that normalizes extreme spending.
I'm so glad you brought up the algorithms because that perfectly explains the travel now, pay later trend.
Yeah, that's a big one.
We're seeing 26-year-olds taking out 2 lakh personal loans just to go to Paris. They spend a week taking photos in front of the Eiffel Tower to post on their grid. The trip ends, the likes fade in 48 hours, but for the next 3 years, a massive chunk of their monthly salary is automatically deducted to pay for a vacation they have barely any emotional connection to anymore.
It is the ultimate commodification of experience.
Completely.
The lived experience itself is secondary, proving to your digital network that you possess the socioeconomic status to have that experience is the primary goal. And honestly, nothing broadcasts that status louder than the device you use to access those networks.
Oh, the Apple obsession.
Yep.
The pressure to own the absolute top-tier device like the iPhone 17 Pro Max is immense. There is documented data showing that young people feel a genuine sense of social shame if they are seen using a phone that is 2 generations old or an Android device.
And how do you afford a 1.5 lakh phone on its 62,000 salary? You rely on EMIs. Equated monthly installments.
Let's look at the numbers.
The sales data backs this up dramatically. During the 2024 Amazon Great India Sale, 1 out of every 4 smartphones sold was purchased on a loan.
25%.
Exactly. 25% of the total volume. And crucially, 80% of those specific loans were packaged as no-cost EMIs.
Okay, let's dismantle the no-cost EMI myth right now because
Yeah.
it is one of the most brilliant and deceptive pieces of marketing terminology ever invented. It implies you are getting free money, but the math tells a very different story.
It really does. The premise is that the merchant discounts the interest from the product's upfront price, so you just pay the principal over time. However, the system is designed with multiple hidden layers of extraction.
Sneaky layers.
Very sneaky. First, the government requires an 18% GST on the interest component of that loan, which the consumer pays. Second, the bank charges a processing fee, often around $199 plus GST.
And it doesn't stop there. By opting for the EMI, you almost always forfeit the upfront cashback offers or reward points you would have received if you just paid in full. Plus, many banks charge hidden pre-EMI interest for the days between your purchase and your first official billing cycle.
So on a 1 lakh phone, by the time you add up the GST on the interest, the processing fees, the lost cashback, and the pre-EMI charges, you were easily paying an extra $1,700 to $2,000.
Wow.
It is definitively not no cost. You are paying a premium for the illusion of affordability.
You are bleeding out through 1,000 tiny cuts. But, while the immediate financial drain of paying $1,700 and hitting fees or dropping your entire paycheck on auto deductions is incredibly painful, there is a much darker layer to this.
Yeah, there is.
We need to talk about the permanent digital footprint this behavior creates.
If we connect this to the bigger picture, we have to zoom out and look at the invisible tracking system monitoring all of this, the Civil score.
The dreaded score.
Right. Every single time you use a BNPL app to finance a 499 transaction, that data doesn't just evaporate. It is processed through non-banking financial corporations, or NBFCs, and it's permanently logged in the Reserve Bank of India's databases. Your financial reliability is being updated in real time, microtransaction by microtransaction.
It's like an algorithmic elephant that never forgets a single mistake. Your entire financial reputation is constantly on the line, even for a plate of biryani.
And that algorithmic memory can devastate your future in ways you just wouldn't anticipate. Consider the impact on employment, for example.
Sure.
Imagine a young professional who takes out a small personal loan and misses a tiny Euro 2,800 EMI payment 3 times due to carelessness. They eventually pay it off and forget it ever happened. 5 years later, they apply for a senior corporate role. They ace the interviews. They are highly qualified.
But the company runs a standard background check. pulls their CIBIL report, and sees those three defaults from half a decade ago. And the company pulls the job offer. Not because the candidate lacks talent, but because a risk assessment algorithm flagged them as financially irresponsible over a 2,800 mistake made in their 20s. That is a brutal reality check.
Let's look at an even more expensive consequence, the house penalty.
Oh, this one hurts.
Fast forward to age 35. You are finally ready to buy a home and apply for a 60 lakh home loan. You assume your CIBIL score is a stellar 780, but when the underwriter pulls the report, it's sitting at 700.
And why the drop?
Because 7 years prior, you missed a single credit card payment that slipped your mind. As a result of that lower score, the bank refuses to offer you their prime interest rate of 8.5%. Instead, they approve the loan at 9.5%.
A 1% difference sounds completely negligible. Most people would think, whatever, I'll pay a few thousand extra rupees a month to get the house.
But when you amortize that tiny 1% increase over a 20-year home loan, you end up paying an extra 15 to lakh in interest.
That's insane.
That one missed payment on a pair of headphones years ago essentially costs you the price of a luxury car down the line.
So what does this all mean? When we synthesize all of this, the seamless psychological manipulation of the checkout UI, the hidden fees disguised as no cost, the mathematically terrifying compound interest, and an algorithmic tracking system that penalizes you for decades, you realize this is about much more than just bad budgeting.
No, it's a systemic treadmill.
A treadmill designed to keep you running just to stay in place. By constantly borrowing money to keep up with the manufactured, perfectly curated lifestyles of strangers online, an entire generation is willingly chaining themselves to their desks. The analysis uses a very powerful word for this state, nihilism, which means employee. When your 62,000 salary hits the bank and instantly evaporates to service 5 different debts, you lose your agency.
You strip yourself of the ability to absorb risk. You can't afford to quit a toxic work environment because you absolutely need next month's salary just to clear your lazy pay balance.
Right.
You certainly can't take 6 months off to upscale or start your own business.
You have traded your future freedom for a present aesthetic. And as we wrap up this deep dive, we have to follow the money. Who is actually benefiting from this fictionless debt culture? Because someone is getting astonishingly wealthy.
Absolutely.
The lenders are experiencing historic profitability. We are talking about one single company holding $55 billion in loans, generating 55,000 crore INR in annual revenue. Another major payment platform has disbursed 52,000 crore in loans.
The entire ecosystem of lending institutions actively relies on this culture of constant comparison. They require you to feel socially inadequate without the latest flagship phone or the flashiest destination vacation because your insecurity is quite literally their revenue model.
So for you listening right now, we urge you to take a hard, unfiltered look at your own phone. Look at your automated deductions, review your bank statements from the second day of the month. Are you actually buying things that bring you deep, lasting joy and utility? Or are you financing things simply to gain the fleeting approval of an algorithmic feed?
We've explored how seamlessly this technology operates to remove all friction from borrowing. But this raises an important question to leave you with today.
Yeah.
If these massive financial institutions are so incredibly eager to fund our impulsive lifestyle choices, from a late-night biryani order to a flagship smartphone, all at the mere tap of a button. At the mere